And we're live. Happy Wednesday, everyone, and welcome to the Mojo Show, your real estate podcast where we talk about everything real estate. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage.
This week's episode, we've got a great show for you this week. We're continuing on with our series on how interest rates affect different aspects of the housing market today. And today we're focusing on VA IRRRL and FHA Streamline Loans, a quick path to lower rates. But before we get to that, of course, our coffee talk this morning, we always have every morning, but this morning we want to talk about something a little different. That's travel. Traveling, whether you're going by plane, car, train. What a great movie that was. Side note, right? With Steve Martin and Planes, Trains, and Automobiles.
Oh God, the big guy, John Candy.
Yeah, John Candy. There you go. What a great movie, right?
Yeah.
Classic. But,
well, that brings up, planes. That's going to be the one that I'm going to throw out there for you today, Joe.
All right, tell me.
So, I was in Michigan last week at UWM, learned a great bit about refinances, got to connect with a bunch of our people. And just before I get into that, if any of our viewers, if you start hearing dogs barking, it's because I'm at home today and my dogs are always around. And if something rings, they're going to bark. So I'll hit mute as quick as I can. But so I want to talk about the travel. Okay. One, I don't get the Detroit airport why you can't go from one terminal to the next. So if you're American Airlines, you can't get over to the Delta terminal. That just drives me nuts.
Yes, totally.
Without going out and going around. So if you're ever traveling, make sure the people that you rent a car with are on the same airline. So you're in the same terminal. That helps. Yeah. But so I was trying to change my flight to go from Michigan to Nebraska. Mm-hmm. And, UWM's great, but with the costs and stuff like that, it can't happen. Mm-hmm. So I get online and I'm like, okay, I'm going to book a flight from Detroit straight to Omaha. And I look at points and it's like 30,000 miles. I look at cost, it's $433 for one way. And I'm like, oh, that's just ridiculous. So I'm going to fly back to Dallas. And then I looked at a flight from Dallas, from Dallas to Omaha. It had one stop. Is $145 for one way. Guess where that stop was?
LA.
No. Fly back to Detroit, get on a flight in Detroit, and then come to Omaha.
No way.
So I couldn't book a one way from Detroit to Omaha for under $433. But if I flew all the way back to Texas and then turned around, got on a flight an hour later that I booked, it would go from Dallas to Detroit, had a layover of 30 minutes, and then from Detroit to Omaha for $145.
I don't. That's ridiculous.
And I did call the airline. I was like, okay, well, if I book this flight and I don't check in for the first leg and I'm already in Detroit, can I just get on the second leg? And you cannot do that.
Yeah, right.
So I was trying everything that I could do, but I got shot down on that one. So
when you went to Dallas, where you flew to Dallas, right? Then you had to run down to baggage claim.
No, I decided to not do it because I was like, I'm not going to fly from Detroit to Dallas and then fly back to Detroit because that flight, it's almost 3-hour flight, 2.5 or something like that. So instead, I rented a U-Haul car trailer and brought my daughter's Jeep up to Nebraska. So I drove for 10 hours instead of doing the flight. So.
Wow.
Yeah.
That's tough.
So that was the travel stuff I wanted to talk about because I just don't get airlines sometimes.
I don't understand either. You're the Detroit hub there for Delta. If you're right, the way that they built it, because it's the old terminals that they used to have is where all the other airlines are, American, United, and all of them, right? Spirit and so on. And then they totally separated Deltas and put it south.
Gotcha.
The whole thing. I remember when that was being built, even totally ridiculous on how they have that structured. But then there's other other airports throughout the United States I've been to that are just, Boston is always under construction. Always.
Yeah.
Anyways,
No,
but then there's some that are really nice. Anyways.
Well, so I know we have a good show today, and I'm excited to get into it, but we really want participation. So anybody that's watching, if you want to ask questions or make comments or correct us, because sometimes when we're talking about things, we've been wrong, and we'll talk about that when we get to VA IRRRLs and VA loans here in a second, because I'm going to publicly apologize to my buddy Joe. But I'm really excited today. So ask those questions, participate in this show. But let's get into, Joe, FHA Streamlines. I want to know kind of what are the benefits of a FHA Streamline in your opinion?
Well, FHA Streamline, a big key to it is that you're not taking any cash out. That's going to be the first key to this, right? So if you have an FHA loan and you're wanting to just lower the interest rate, that's all you're looking to do is lower the interest rate. You're not looking to take any cash out. This can be actually a great option for you. One of the benefits to using it compared to a standard loan refinance, is that with the FHA Streamline, you don't need an appraisal, right? And that's a big savings right there. It could be $600, $700, $800 savings just right there in not having to use an appraisal, which makes it faster, easier process. And there is also, as a side note, with FHA, when you got, those of you that have an FHA loan, when you originally got the FHA loan, you had a charge at the beginning that was added on top of your loan. The balance of your loan was added on top of it. You didn't have to bring it to closing, but it's called an upfront mortgage insurance premium. Oh man, I always forget the numbers. What's the percentage, Joe? 1.5?
1.75 is the percentage for your upfront.
Okay. So that's tacked on top of, that's to get the benefits of the FHA loan. Now, when you do a FHA Streamline, you may be able to recoup some of that back. So there's another benefit to that. So a couple of them right up front, Joe, definitely.
Right. Yeah. There's a chart. So within the first 3 years of you being in that FHA loan, you get a certain percentage back. Mm-hmm. So that's the whole thing about the FHA Streamline is you still have to pay another upfront, but you can get a refund. So it kind of knocks it down some. So that's a good thing. Right. So,
that refund though, let me just add that refund, Joe. When we say refund, everyone, when we say that, that doesn't mean that you get the cash in your hand. Okay. That doesn't mean you get the cash in the hand. It's going to reduce the balance when it's refinanced over.
Okay? Right. It'll reduce the new upfront mortgage insurance that you're paying. So that's how it works. So you're not losing on it.
Right.
The another benefit of an FHA Streamline is, after you make your 6th payment, that's when you can actually do an FHA Streamline. So if you have assets, because we're going to get into some of the things that were required on an FHA Streamline. But before we go to the asset part, the interest rates on an FHA Streamline are typically better, because companies are like, okay, well, we know rates went down. We want to keep them, keep these clients. So they'll give you a little bit better of a pricing on that new interest rate through like an FHA Streamline or a VA IRRRL. Or a company might run a little promotion, right? That'll give it. Like UWM did one for us, and I know I'm talking about them on here, but they did one for us, right? Where we could take off 75 basis points off their pricing. There was one where they did 100 basis points. So that they do different things like that for us to be able to, help our clients, but also it's a way that they can keep their clients instead of losing that off their books. So I think that's a great way, the benefits of the FHA Streamline in that case. I will always say, on an FHA Streamline, a lot of first-time home buyers use it, people that maybe don't have as much in assets. So where the negatives of an FHA Streamline come into place is there's no way of wrapping in the closing cost right now in the market we're in.
Right.
And so you're going to have to come out of pocket for the closing cost and your escrow setup. You know, in Texas, we pay our taxes once a year. We pay them in December. You know, once the bill comes out, they're technically due. And this is one thing, if you live in Texas and you're wanting to know why, because on your tax bill, it says due by January 31st of 2025 right now. Well, that due by is like the last day that you can pay it. But when the bill comes out, that's the actual first technical due date in lending purposes. So once that bill comes out, a lot of them are already come out 1st of October. Some of them start coming out now in the middle of October. But by November 1st, most all counties in Texas have their tax bills out. So why it's hard for us right now to do FHA Streamlines is because if you have a tax bill of $8,000,
you got to come up with that now.
That's $8,000 you have to come up with because your escrow account hasn't paid it yet.
Right.
And most of the time, escrow accounts pay them in December. So, you know, a lot of times we want to wait and time it right to where once your taxes are paid by your escrow, then we want to close on that FHA Streamline.
Right. So like January, February kind of time.
Yeah. So that, or you can close in late December. As long as you know the taxes were paid and it's showing at the county, then you can restructure your loan. So anybody that's doing these, you need to understand that. But that's why, like when I'm talking to clients right now, and I met with a client up here in Nebraska just yesterday. We did an FHA purchase. They're at 6.25, and we were looking at, you know, does it make sense to maybe have a discount point on there or two and try to drop your rate? And they're in that situation where they don't really have the funds. And I closed them last December, so I'm not where I can do a full FHA refinance. And just a real quick, the difference between the two is a full FHA refinance. You can get a new appraisal, but you have to have owned the house for 12 months from note date to note date. Okay. You also have to wait for the appraisal until you've been in the house 12 months because it cannot be a day before. You know, so that's one of the things. And, you know, and then if the house appraises for more and you're doing a full credit qualifying with income documentation, asset documentation, then you can wrap in closing costs. That's the difference between a streamlined FHA loan and a true FHA refinance.
So, and if any of you have questions on this, because some of this, you know, homeowners, when you hear some of the stuff we're talking about, maybe a little bit too deep in that's okay. Yeah. Post questions. We can help you with this. If you have an FHA loan, this is a great time to try to see, is this something that would fit in your needs? Because have come down most likely since you got your FHA loan. However, as Joe was saying, it may be beneficial, you know, to do, matter of fact, let's break that down even, Joe. As far as the difference, you were just talking about the difference between an FHA Streamlined and a regular FHA straight refinance, right? The differences there, you and I were talking before in regards to the points on the interest rates may be at a way as far as with FH Streamline that it's not beneficial right now.
Yep. I mean,
elaborate on that.
Yeah,
I didn't set you up very good for that, did I?
It's okay. So, you know, we talk about this all the time is there's always a cost associated to doing something. And I'm a big believer in what is that break even point from the cost to do the loan versus the new interest rate and the new payment savings. So, you know, if you're having to come out of pocket money on an FHA Streamline and you have the assets, you know, I want that break even probably to be closer to that 2 year, maybe 2.5 year mark. Because you're having to come out that asset out of your savings account, you know, and bring it. If you're doing an FHA, you know, regular FHA full qualifying, and you're not having to bring maybe one payment to closing, you know, in Texas, we can't give any cash back, and it's very difficult to make it zero. So I would always tell my clients, assume you're going to bring, you know, anywhere on the low end from $500 up to one payment, because it's easier for me to get in there. If you're doing that, then I want that break even to be, you know, under 3 years, 3 years or under. And what I mean by break even, if you know, and this might be elementary, everybody be like, oh, I know what break even is. It's basically if it's costing you $5,000, right, and your savings only $100, it's going to take you 50 months to make that back.
Yeah.
But if you're now saving $250, well, now it makes sense to pay, to have that $5,000 cost.
Right.
Now I will say this, Joe, and I'm going to send this to you too. Patton Gade shared an Excel sheet with a great way of showing true savings. And it might actually make sense to refinance before that if you can keep maintaining that same payment. So let's say I drop your payment by $200. Well, if you keep making that same payment, you can start reducing the term of your loan. You can have more equity in your home over that year to 2 years. Yep. So there's reasons for it, and not always just thinking about interest rates, but you still want to have a break even. You still want to have where you're saving more money in under 3 years than you're costing you to do that loan.
Absolutely.
Hopefully that answered your question that you were wanting to me to
Yeah, absolutely. I appreciate it. Now that's FHA Streamlines. Let's switch gears a little bit. Let's talk about VA, right? With VA Streamlines, we refer to it as a VA IRRRL, right? IRRRL. So a VA IRRRL. Joe, what are some of the benefits that you can tell people in regards to a VA IRRRL?
So I will tell you, this is VA loans to me are the best loan out there. They're given to the best people out there that have, that went out there and did something for my freedoms, served our country. So, I really do love the VA IRRRL. So if you bought your home with a VA loan, you're in a whole different ball game than anybody else. And what I mean by that is on a VA IRRRL, you don't have to have an appraisal. You don't have to give us income documentation or assets. We have to now make sure we pull your certificate of eligibility and it's still there. But we put in a value that we believe is right for the area. And then we build out your loan to where closing costs, your escrow setup, everything can be wrapped into there. Now your loan amount's probably going to go up if you bought your house in less than, a year. But after you make your 6 payments, so it still has a 6-month rule of payments, you can do it. But now we can wrap in closing costs because we can take the appraised value up. There's no appraisal. And we can structure it to where that closing cost is in there, where you're still bringing anywhere from $500 to your first payment.
Yep.
And I really like the VA IRRRLs just because you don't have to truly have a credit score. We've done them without credit scores. We don't look at a whole credit history. We look at your mortgage payments. So as long as you're making your mortgage payments on time,
you're good.
You're good. So those are some of the really good benefits of VA IRRRLs in my opinion. So I would love to know, Joe, is there any other benefits that you see in that?
No, I think you hit it all of it right on the head of the nail, right? So no appraisal, no income as far as that we have to prove or show, right? No credit pull, right? And you can wrap everything into the closing so that you're not having to bring thousands of dollars, just like when you first closed on your house.
Right.
So VA IRRRL, hands down, is the best way to go. So if you have a VA loan, and I would say what would you say as far as today? Today is October 16th, 2024. Put that in there real quick. As far as today's rates, because I don't want somebody looking at this a year from now and going, wait a minute. No, today, October 16th, 2024. So, if somebody has an interest rate of what would you say, Joe, 7 and higher, or
right now on the VA IRRRLs,
looking at?
I would say if you're at 6 1/4, it's time to start talking. It's time to start talking. Is it the right time? Maybe not yet, but at least this way where are we at today. Everybody knows the Fed dropped the rate. Well, after the Fed dropped the rate, we lost over 200 basis points in cost to do that same interest rate.
Right.
So, it did not affect the mortgage interest rates in a positive manner because the factors of like job reports, inflation, and all that stuff, that's what really, and we talked about that on a previous episode. That's what really our rates are driven by. So I would say at 6 1/4, Matt Ishbia actually came in, Joe, and talked to us at the Success Track. And he was talking about refinances. And he's saying anybody above 6%, it might be the right time.
Okay.
With a VA IRRRL, you can look at discount points, because on a VA IRRRL, one of the positives to me, but negatives to others is if you're not breaking even in that 36-month range or less, you can't do a VA IRRRL.
Right.
I think that's a great benefit of the VA IRRRL. So
that's a rule, right?
That is a rule.
That's a VA rule that they have, that you have to break even within 36 months.
Yes. So, buying down the rate could make sense a little bit because, if I'm dropping your payments $350 a month, well, if I'm paying a point or a point and a half, it could make a lot of sense because I'm going to be finding that break even depending on the size of the loan. So I do think Matt is on the right, concept there. It's also our job to make sure we're the professionals in giving guidance. Right. So if you get somebody, Joe, and you're looking at them and they're right at that 36-month mark and it's really only saving them $125, you're probably going to be that professional to be like, hey, we could save you this. This is where it starts, turning in your favor. This is how much more equity you have in your home. You're not talking just about waiting for the interest rate. You're also talking about how long is this client staying in the house?
Yes.
Because that client is, I've got clients right now, like the one I met yesterday, they don't plan on moving. Now life happens, but if you're not planning on moving, then, maybe doing that $125 or $150 savings is smart if we're under that 3-year break even. So I think we have to do a better job in lending to be like a financial consultant and also tell them what our opinions are, but it's ultimately your as a mortgage choice. Yeah. And one of my biggest things that I do all the time is that $150 putting more food on your table, putting more money in your savings account? Because if it's one of those two, I think it's the right thing. If it's able to put more food on your table because you're struggling, then we can do that because I want you to stop struggling. If you're putting another 150 into your savings or keeping it on your payment and you're paying your equity, you're building your equity quicker, then guess what? We'll do that.
And it's our jobs, and those of you that are loan officers listening in, I think you will agree, it is our job as loan officers, our fiduciary duty as far as being able to ask the right questions to know the client's goals, their needs, and how to align them to put them in a better financial position. Like Joe was just saying, how long are they going to be in the home, right? Because if they're only going to be there for the next 2 to 3 years, then is it really worth refinancing, spending the money to refinance, right? If they're going to be there 5, 7, 10 years from now, that may be a better option to look at with an early break even of 2 to 3 years. Yes.
Well, we have a couple of comments. I'm going to first say, we're going to give a shout out to our man, the myth and the legend of Coffee Roundtable. Josh Reed out in Florida. I'm hoping that you and Liz are having a great time out there with Tyler and Kim and Riley and Steven. So the whole thing out there. Thank you, Josh, for tuning in today and giving us a shout out from Florida. And then Joe, we have a question, and this one always gets me. Okay. What does IRRRL mean? Okay. Can you spout it off the top of your head?
Yep,
Joe?
Sure can. So IRRRL, the IRRRL, means interest rate reduction refinance loan.
There you go.
Right. There you go. So it does exactly what it's saying that it does. It's an interest rate reduction refinance. Yep.
And Chris Baker, love you to death. I think you were trying to stump us there because I know you know that answer. So, we do appreciate you guys listening in and putting in the comments for us. But I will say the VA IRRRL is one of the best to help you really reduce that interest rate. And then, see, I knew she was trying to stump us because she said, you are correct. So, well, thank you for tuning in, Chris. Let's kind of talk about the current market conditions
Okay.
on, because I know we're getting to that time. We'll get wrapped up by 9:30. That's my goal today, is get us off on track. But
well, we got good information today for people, so
correct.
Let's make sure we give them what will help them. But go ahead,
Right.
Joe.
So market conditions, Joe, in your opinion,
Yeah.
with what we said about, the Fed lowering the rate, but now it kind of increased. When do you think that the market is going to settle a little bit for an FHA Streamline to be looked at, or a VA IRRRL? And what I mean by that is are we going to see any kind of what's called premium pricing? And now I'll let you explain what premium pricing is. Do you see that coming back?
That's what I was referring to earlier, by the way. It was premium.
Oh, is that okay?
I didn't say the right words. My vocabulary wasn't kicking in yet this morning.
Well, tell our listeners what premium pricing is. Let's start with that first.
Okay, so premium pricing, when we talk about premium pricing, folks, we're talking about interest rates that have negative points. Okay, so we've all heard about, buying down your interest rate with points. Well, those are positive points. Positive points are points that you pay the lender in order to have that interest rate. Negative points are where the lender pays you that money to be able to take that interest rate. So you may be taking what seems like a little bit higher interest rate, but if the lender is going to give you $2,000 or $3,000 at closing to take that interest rate, you can use that money and apply it towards your closing costs. Now, I did that actually back in the spring for a client of mine that was moving. They were only going to, they sold their house, they hadn't sold their house. They were buying a new house in a different city. And after moving, then they were going to sell their current home. So, and then take the proceeds from that and pay off the mortgage. So within 6 months, 6 or 7 months, they were going to pay off this mortgage, this new mortgage. So you're only going to only have the mortgage for 6 or 7 months. There's no sense in buying down the interest rate. Let's do the opposite, right? Here's where, right, knowing the client's goals and what they're trying to, and their needs, and putting them in a better financial position. So what we did is we took negative points, higher interest rate, negative points, but all that money helped pay almost all of their closing costs.
And that's what we used to do on FHA Streamlines back in 2020, 2021, when all the refinance boom was going on. Is there was premium pricing because rates were low and investors aren't scared of people refinancing, because that investor is making money over long term with that interest rate. So that's why right now we're not seeing
right now we're not
the premium pricing on these types of loans, or even in general. You might get a half a point here or a point there, but it's not the same, because you're not dropping the interest rate in today's market.
Right.
So that's why FHA Streamlines are a little bit more difficult than right now, where VA IRRRL, you're allowed to take up that appraised value to make it work. So that's where the positives between the two are. But from a market condition, it's really, there is no, we're going to pay you to take this interest rate, because they're afraid that, when interest rates do drop, because we have the election coming up.
Yep.
And with that election, in my opinion, that's when we're going to see, okay, what is truly going to go on in our market?
Yeah.
And, is it, and I'm not talking, make sure you guys understand this. I'm not talking if we get a Republican in there, if we get a Democrat in there. I'm just talking in general, after the election, that we'll see what the mortgage-backed security purchase market will look like, and based on the confidence of those investors.
And right now, because of that, I know you and I have both seen it, Joe, that interest rates have really just been, besides when the Feds cut interest rates and we had mortgage rates bump up, besides that, they've been pretty flat lately, right? Pretty flat. Just a little variance here and there, but pretty flat. I think everybody is waiting, anticipating for the election. And like you said, whichever direction it ends up going, Democrat, Republican, who knows? But then we'll probably see some changes. Yeah,
I agree. So I know we were going to go to questions and myths. So let's try to hit those real quick. And Joe, I'm going to say, on a Streamline or an IRRRL, do I have to get an appraisal?
No.
Okay.
No. For both of them.
One thing that everybody needs to know is you do not have to get an appraisal. On an FHA Streamline, though, you have to use the purchase price. So that is why they're a little bit more difficult to ever wrap in. That's why they're not allowed to wrap in closing costs. Where VA IRRRL, you can go with a fair market value or a little bit of an increase based off of trying to get your closing costs and stuff wrapped in there. So that is a myth where you do not need an appraisal, but on a VA IRRRL, you can change the value over the purchase price to make those closing costs work. And
a quick question here for you, Joe, just to clarify, like you said, with an FHA Streamline, we have to use the original purchase price value. Yes. Can a homeowner go ahead and pay for an appraisal if they feel that there has been equity built up, though?
It's a great question, because you would think yes, but it's a no. and what I mean by that is, so FHA also has a rule that if you've owned the house less than 12 months, which I said earlier, you cannot get a new appraisal and use that in new appraised value. But also on an FHA Streamline, even if you get a new appraisal, that could help you maybe in your pricing, where if your house appreciated, but you're doing the Streamline, you still can't wrap in closing costs with that new value, because there is a calculation that makes us know exactly what FHA will let your max loan amount be based off of your original loan amount. So if you're truly doing an FHA Streamline, even getting an appraisal, it could help you with getting a better interest rate maybe, but not with wrapping in closing costs. The only way to wrap in closing costs on FHA is doing a true full credit qualifying, income qualifying refinance.
So a regular FHA refi.
Yes, sir.
Essentially. No cash out, but just
no cash out.
Right.
And that's another thing in the state of Texas is we can't do cash out on VA and we can't do cash out on FHA. So 58.6 laws limit that to where you cannot do those on those two loans.
Other states we can.
Some, yes.
Right. Okay, good. Now, how about, do we have to have, because some people think this, in order to do refinance, that, well, my credit dipped a little bit. Do I have to have, perfect credit to be able to do this?
That's another good one. You do not have to have perfect credit on either one of these. Your mortgage has to be paid on time for 6 months, so that is the one thing. You can't get around the mortgage. But if your FICO score is dropping, that can affect the type of interest rate you can get, because we still pull a mortgage credit only to where it gives us mortgage pay history and gives us a FICO score. So if you have a FICO score of 780 versus somebody that has one of 640, that 780 is going to get you a better interest rate because of it. Sorry, guys. As you can see, my dog loves me. But
I didn't know if that was you moaning or
no, it's this thing right here. So, but you gotta see that part of it, and I think you'll be fine.
Okay.
The last question that I kind of have here, Joe, and this one is where I'm going to apologize to you. If you are in a non-community property state and they are doing a VA or even an FHA loan, do you have to pull your spouse's credit if they're not on the loan?
Did you say community or non-community?
Non-community property states.
Non-community. No, you do not.
Like Michigan by chance. I don't know why I would say Michigan.
Just by chance, right? Just by chance. No, you do not need to pull a credit report on the spouse.
Yep.
Even if they're not on the.
That is where I'm going to give Joe my apology, because I've been in this industry for 23 years, and I will tell you, I've done a ton of community property because Texas, I do them all the time. I told him the wrong information. He went to the client, kind of got a, don't think that's correct. And then I asked some questions and I had to apologize to Joe. So Joe,
all right, buddy.
Again, thank you for teaching me something, because that was something that was needed.
Okay, but let's expand on this a little bit, Joe, because if you do live in a community property state, like Texas, for instance, I don't know I'm sure there's other states that are community. I think
there's 9 total states that are
9. Okay, so let's say you live in a community property state, and your name is on the FHA or VA loan, but your spouse, their name is not on the mortgage. Understand that in a community property state, we still have to pull credit on your spouse, even though they're not on the mortgage.
Correct.
So
now they're just a high level, because somebody on here will comment, oh, that's not correct. So on a very high level, if you're doing a VA loan and your spouse that's not on the loan with you has a job that makes sufficient income to pay her debts or his debts and to pay their living kind of expense, then you can, not have to include those debts on a VA loan in a community property state. So just a real quick clarification in case anybody's like, oh, you guys aren't telling the whole thing. Oh, there you go. So,
well, and as we start to wrap things up, Joe, one last question or myth, if you will. Question myth, I guess this is more on the question side of it. As far as anyone listening in, if you are considering or thinking about what's his name? Come on, what's his
this
name?
is Remington. She Remington? Is my Great Dane that just thinks she owns the world. Danes.
Beautiful, just beautiful. That's all. How big? I mean, how many pounds is he?
She's only about 110. She's on the small side.
Okay. So, all right. So those of you that are, thinking you have an FHA or a VA loan, you may be wanting to know as far as what would I do to get started, right? So Joe, maybe you could elaborate for everyone. What would be the first step for people to investigate this to see if it's a right fit?
First step is you email Joe or I, and we will get on the phone with you, and we will be glad to walk you through any kind of options that you have available. If you have a good lender and they helped you and you want to go back to them, because that is what we are, is about relationships, call your lender, talk with them, and if they're not calling you, then that might, that give them a chance. But if they're not calling you, then, get with somebody. If you're in a state that Joe and I aren't licensed in, we know somebody licensed in that state. I can tell you right now, we've got a ton of people that work for our company that are awesome loan originators about relationships, and they would be glad to help you. But you got to start by talking to a mortgage professional.
And, if anything is needed after that, as far as documents and that, we'll let you know. But the first step is really to kind of take a look at the numbers and see, does it make sense? Let's do that first before we have you start pulling documents and everything, W-2s and pay stubs and all that, right? So first step is a good consultation phone call.
Yep. No, I agree.
All right. Well, if any of you have any additional questions or want to get a hold of Joe or I, you can always, as a matter of fact, let me run the banner down there below. Do we have it? Oh, there it is. There we go. Pick it up down there. The Mojo Show Podcast at gmail.com. You can always reach out to us there. You can find us on social media as well to grab our phone numbers. Call us direct if you'd like. Reach out to us if you want any more information or see if a VA IRRRL or FHA Streamline might be a fit for you. Now, next week we're actually going to take off. So give us 2 weeks. 2 weeks from today, we'll be back on with more educational content for you to be able to learn more as far as the real estate industry itself. Want to thank everyone for listening in, and definitely those that commented. We really do appreciate you very much. And if you only caught part of this show, want to see the rest of it or any of our other shows, go to our YouTube channel at the Mojo Show Real Estate Podcast and check out all of our videos there, all of our episodes, I should say, or podcast episodes there. A lot of great content to learn from. And while you're there, go ahead and hit the subscribe button, because we are on a mission to get to 1,000 subscribers. Before we close things out, Joe, any last words or nuggets of advice for our listeners?
There's a nugget of advice right there. Go to our YouTube channel and like and subscribe.
Awesome. Fantastic. Well, you have a great week, everyone. I'm Joe Mortgage, and that handsome guy there with the beard is Cup of Joe Mortgage, and we'll see you next week. Mr.